Do you know what the most profitable global fund of 2023 invested in? It's not stocks, nor cryptocurrencies. It's a very mysterious financial product called Catastrophe Bonds, or CAT bond for short. You're probably thinking, Cat what bonds? Catastrophe bonds deal with major disasters. In 2023, they achieved a return rate of 20%. You might say, 20%? That's not that impressive. Bitcoin can rise 20% in a day. You're probably wondering, what's a catastrophe bond? It's simple, a bond linked to big disasters. In 2023, these bonds had a return rate of 20%. You might say 20%? That's not that impressive. Bitcoin always can go higher than that. But here's the thing. In the finance world, if you only look at returns and ignore risks, you're not being smart. Otherwise, why bother putting money in the bank? Just invest in Bitcoin, right? Take a look at this. In 2023, US bonds generally had an average return rate of approximately 4 to 5%, depending on the type, like treasury or corporate bonds. In contrast, catastrophe bonds achieved an average return rate of 20%, which was significantly higher. Not only are cat bonds' returns high, but they're also relatively stable compared to the volatile nature of equities or other high-yield investments. So, what makes these bonds so reliable for a 20% return? Is it some sneaky capitalist scheme? Let's take a closer look. Catastrophe bonds are actually easy to understand. They are similar to regular bonds. You receive periodic interest and get your principal back upon maturity. Now you're probably thinking, how can something give a steady 20% return? Is this just another sneaky product made by Wall Street? Let's explain what catastrophe bonds are. The concept is straightforward. They work like regular bonds. You receive interest payments at regular intervals. And when the bond matures, you get your principal back. But there's one big difference. You're essentially making a bet against nature. If a major disaster occurs, like a hurricane, flood, wildfire, or earthquake, you might lose part or even all of your initial investment. But don't worry, it's not vague. Every catastrophe bond comes with strict conditions. It specifies the time, location, and type of disaster. For example, let's say you buy a 5-year bond. If no disaster occurs, you earn the risk-free rate plus 10% each year. But if a hurricane hits Florida, with wind speeds reaching a certain level, or if a named hurricane makes landfall there, the disaster clause is triggered, and you could lose your money. Think of it this way. It's like putting your money in a bank, earning 10% extra interest each year. But if a severe hurricane strikes Florida, your money is gone. The example I just gave is real. Florida hurricane bonds are very popular right now. Why? Because after the pandemic, many people moved out of crowded cities like New York. They settled in Florida, where the weather is nice and life feels like a vacation. With this influx of people, Florida's housing market has boomed. More people are buying homes, and that means more are purchasing insurance. Insurance, in turn, is tied to hurricane risks, and these risks link back to Florida's catastrophe bonds. There are other bonds for disasters too, like California wildfire bonds, Japanese earthquake bonds, New York flood bonds, and even a new type called cyber cat bonds. Cyber cat bonds cover disasters like hacking attacks on companies. Imagine that, a cyber attack counted as a catastrophe. So why would anyone buy these bonds? It's simple. As long as no disaster happens, they're very profitable. Take the Florida hurricane bond example. That 10% return I mentioned, it's not made up. The risk premium really is that high. In general, catastrophe bonds have risk premiums ranging from 3% to 15%, and in recent years, most have been above 8%. So what's the risk? Well, the probability of a disaster occurring is usually between 0.5% and 2% per year. This means you only take a small annual risk of losing money in exchange for an 8 to 10% extra return. Sounds tempting, right? But here's the catch. These high returns aren't for everyone. Only highly specialized hedge funds actively trade catastrophe bonds. These funds focus not on typical financial analysis, but on predicting weather and natural disasters. They calculate the likelihood of a disaster happening. That's how they decide if buying a bond is worth it. And it's not a one-time decision. They continuously assess disaster risks as bond prices change. For example, imagine a hurricane forms offshore and starts moving toward Florida. Bond prices would drop sharply, If the storm seems likely to make landfall, prices drop even more. If a hedge fund predicts the hurricane won't hit, it might buy the bonds at a discount. If the storm misses, bond prices bounce back, and the fund profits. Similarly, if a wildfire starts in California, fund managers might use satellite images to evaluate the risk. As you can see, this is not a game for amateurs. These returns come with serious challenges. Some of you might ask, wait, if no disaster happens, why did these bonds return 20% in 2023 instead of 10%? Here's the reason. In September 2022, Hurricane Ian struck. It was the most destructive hurricane in Florida's history, causing over $100 billion in damages. This triggered payouts on several catastrophe bonds. Investors were shaken. They worried that climate change was making disasters more frequent and severe. As a result, bond prices dropped in late 2022. But in 2023, no major disasters occurred. Prices recovered, and investors earned both interest and price gains. That's how they made 20%. However, this 20% return was an exception. Historically, catastrophe bonds usually offer less than 10%. So, who issues these bonds? Insurance companies and governments. For example, New York's state government might issue flood bonds to prepare for a potential Manhattan flood. Governments in less developed financial markets, like Mexico or Chile, often work with the World Bank to issue such bonds. When you buy catastrophe bonds, it's like providing insurance to insurance companies, governments, or the World Bank. Investors love these bonds because of their high returns and their low correlation with other assets. This makes them great for diversifying portfolios. In the end, catastrophe bonds spread risks across the market. While disasters still cause damage, these bonds ensure the financial burden is shared. Isn't that fascinating? It's a brilliant example of how financial markets work. So, there you have it. Catastrophe bonds might seem complex, but they're a fascinating way to balance risks and rewards in finance. It's not just about making money, it's about how markets work together to share risks and create opportunities. If you found this video insightful, please like, share, and subscribe to the channel. Don't forget to hit the notification bell so you won't miss our next deep dive into the world of finance. Thank you for watching, and I'll see you in the next video.